Hi, this is Randy Finney with the right side of the chart, and this is a closing market wrap for Wednesday, July 15th, 2020. We're going to go through in this order. We're going to look at the stock market. That'll be brief because we pretty much didn't do anything today. S&P 500 closed up about 0.2%, 0.20. So we're basically flat, no resolution, no elimination of the bearish engulfing candles on the Qs yet. We haven't, taken the top of that out, nor do we have any confirming follow-through sell signals, so that's not much to talk about there. I'll roll into a couple of the recent stock market-related trade ideas, very briefly hit on those again, and then I want to roll into again some other of the recent trade ideas, a little more, going back a few weeks. Been increasingly bullish and adding exposure in the commodities arena. So we'll hit on that. We'll hit on not just the ag commodities, oil, gas, natural gas, that is, and then time permitting, gold, silver, and the U.S. dollar. That's a lot. So here's what we're going to do: it's very brief, broad market, like I just said. Bearish engulfings on Monday on Qs. We did not get any confirming. That's a potential sell signal. No, so far no confirmation. Still possible. We'll just have to see. Today keeps us guessing. If these candles get taken out, meaning we move above it and close above, especially close above it, then they mean nothing. It's just a random bearish engulfing within an uptrend. And if we can move on down tomorrow, especially or this week, any date. It doesn't have to be tomorrow, but sometime soon here before we take out the top of that candle, particularly break below yesterday's lows. That would help to confirm that. So today, the bears don't get a check mark. If anything, the bulls get one. Again, nothing huge, so let's not make too much of it. Let's move on. One more thing back to QQQ. They also, another thing that the bears failed to capitalize on were those potential bear flags. Started to move down earlier today, break down earlier today when I was doing the video, but so far that's fallen. That's not what you want to see. That's not textbook price action, so I wouldn't even give those much more thought at this point. XLK, remember, until tech breaks, the market won't break. XLK defended the trend line yesterday and is still above it today, so no sell signals there. We're about halfway up. Even at the highs, we got about 2/3 of the way up that Monday's candle. Haven't taken it out yet, but really pushing the upper limits. Much more upside, and that just takes away that potential sell signal in the tech sector with the bearish engulfing. But of course, you haven't broken support, and you have quite a bit in these three levels here. Purple uptrend line 103.90ish, and then the big, I think, 101.80. Other than that, the trend is still bullish for now. Of the sectors out there, well, let me hit on SPY, and then I'll tell you the one, or the indexes, that is the one I like the most, which we'll get to in a second. And before we do that, SPY, it's worth noting, SPY is back above that trading range, and there it is, boxed in right here. If I can grab that box and shake it around so you can see it. And then most recently, we had this about 318.30 level we were bouncing on. Not an exact tag there, but close enough. You can see a lot of tight consolidation, little false breakout the other day, so it had some potential, but again, no follow through. We had a whipsaw signal, aka potential bull trap. We moved lower, but then reversed that day, and we're back above there now. We're back to those highs. Now we're still at resistance. So what that's done, well, let's just call it for what it is. It's wiped out. This is a topping pattern. Now, doesn't mean we can't top. Maybe a double top. I'm just saying, when you have an island cluster top, you shouldn't fill this gap, and you certainly shouldn't move above the island. Right now, we didn't move above it, but we're pretty much at the top of it. So again, bears failed to capitalize. Bulls can get a check mark there, but it's minor stuff. Here's a bigger picture. We're still in just this larger trading range. We're back where we were today. We closed exactly where we were, almost exactly where we closed as well, all the way back in the beginning of June 8th, right there, when that green candle was there. So take what you will. There are divergences in place. There will continue to be negative divergences on this much more significant daily time frame should we go a little bit higher here. But as of now, we're above all those key moving averages that sit just below there. You may not be able to make them all out in the video. I have, maybe you can see it. Here's the red line's the 200-day exponential. The blue line's the 200-day simple moving average. You have the 50-day. You even have this little purple line here is a 20-day. So that's constructive technical posture. It could change in a dime, or we can continue to go up. So as of now, really, we don't have any sell signals on SPY either. Okay, enough time spent on those, probably more than I should have. What stood out to me, if there's any one index that stood out today, it's IWM. IWM broke out above the 145 to 146 trading range, or top of the trading range. It's really a resistance zone. I have, the purple line's at 145 and change, but as I said the other day, we had a little candle that popped here, and that candle was checked by the 200-day simple moving average, which is this blue line. Today that was taken out, not by a very wide margin, so you take it with a grain of salt, but I'll say this without hesitation. If I was bullish looking for new highs in the market, and talking the broad market, every other index besides QQQ, the Dow, this is the one I would be going long. This one I think has the most bang for the buck. I'm still a little skeptical of this breakout. It wasn't, wasn't on super high volume. It was decent volume, nothing super high, and we only closed marginally above 146. About a point above it on 150 point security. That's less than, that's less than 1% there. So not a solid breakout, but a breakout nonetheless. So if I were looking for much higher highs in the market, this would be my pick over the large caps or the mid caps. And you could do so with a stop not too far below there, because it should remain ideally above the 200-day moving average and about 145 or so. So the risk reward is there. You can see another variation. I told you before we had an uptrend line, and I didn't want to force this downtrend line, but I did add it here. It does give us what appears to be that it takes the shape of a symmetrical triangle pattern, which if you look at it that way, IWM just broke out right there. So there's a breakout. Again, we're a little bit too close to resistance for my comfort level. Bearish engulfing candles on tech, XLK and QQQ, which are the most important sector and index in the market. They've not been negated yet, so there's still a chance. We'll just have to see what tomorrow and the next day brings. All right, let's move on. And as far as targets, I mean, if this is a breakout and the market's going to new highs, if you're bullish and you're looking, then I wouldn't even look at targets now. I just set a relatively tight stop and let it run for the time being, and focus on that later. I think the small caps, should the economy hold up, which would surprise me, but it's certainly possible, then I think they play a game of catch up to the large caps. It's also worth noting the PPO is constructive right now. It's been above the zero line since back here, and it's turning back up. That zero line, the dash line, often acts as support. So again, of everything out there, I think one of the better looking ones is also above that 50 level on the RSI. That's that midpoint line. That tends to define bullish trends when you're above it, and bearish trends when you're down below it. As you can see there, even though IWM's had a little of both over the last few years. So anyway, that's that. And if it fails, it fails. So like I said, if it fails, you just don't hold a long position to down here. And again, somebody asked me this morning, hey, is an objective short? And I said, absolutely not. Not in my opinion. Not on a breakout above 146 and a breakout above the 200-day. But if it falls back below there with conviction, then yes. But as of now, if anything, like I said, it's a breakout. Okay, and just the two recent, what I call index or tech sector related shorts that we added this week. Adobe still looks good. Like I said this morning, below trend, down today, despite the market being up. What was it? QQQ was up 0.2, and then SPY was up almost 1%, largely due to the financials. But the recent trade ideas, both Adobe and PayPal were down, which shows relative weakness, in other words. And that's, I talked about that this morning, that the market could continue to climb. We've seen breadth deterioration. If that trend continues, the market internals continue to deteriorate, meaning fewer stocks are rising, then you can short a rising market and actually pick individual stocks, the most bearish stocks, the most bearish sectors, and actually do very well in that environment. Like I said, if you wait for sell signals when the market is doing that, if it tops, a lot of those stocks are going to be down 15-20% before the market finally gives you a solid sell signal. So as of now, I'm comfortable with these two, as I said this morning, and we'll just keep an eye on them. If they take out our stops, and so be it, and we move on to the next one. But it's all about diversification, so let's talk on that now. Let's roll into the commodities. Things I've been highlighting now for weeks and even months. Sugar continued to move up. Nice move today in a lot of these commodities. Sugar, SGG, one of the two ETNs, trade up 5% today. Cane up about 3.6%. And it's been consolidating recently after breaking above that inverse head and shoulders bottoming pattern, so it needs to pop here. But really, it's sugar futures. These guys are trying to track. That's what they're attempting to do, is track sugar futures. Here's SB, which are the sugar futures contract, up 5% today. And so you can see SGG did a little bit better job of tracking. And it's been holding the support right there, about 11 cents. Nice support level. Little brief dip below it, but then took out this minor downtrend line, and it's running up. And the next pretty significant buy signal or bullish development will be if and when it can take out this the downtrend line, this recent level of consolidation here. And I really like the, I'm not going to get into all the charts right now, but I like the daily and the weekly charts as well on sugar. Like I said, it's, I think, to me, an infinitely better risk-reward profile right now on a lot of these commodities. I know some people think they're boring, and in comments on the site, someone recently told me that won't trade them because the ETNs are not actively traded. They're somewhat illiquid. Now, here's the thing. I wanted to speak to that. When you go with these ETNs, if you're not, even the futures on a lot of these are not very actively traded. You need to know what you're doing when you trade an illiquid stock, and that is, when you have a wide spread, the difference between the bid and the ask price, split the difference. I like to use Interactive Brokers has an order type called IB Algo, where you enter the IB Algo order. It will then sniff around. Their little algo programs will sniff around between the bid and the ask, play around with things however they do, and try to get you the best fill. And I'll often use that for thinly traded things. But here's what I wanted to get to. These you don't see me put a lot of illiquid stocks, penny stocks. I try to shy away from things like that. You get trapped in those. You take them on a breakout, there's a lot of liquidity, the spreads tighten up, and then all of a sudden that slows down, and then there's these huge spreads, and it can be quite tough to exit. You should never use market orders on a very illiquid stock. Penny stocks, a broker won't let you anyways, usually if on the pink sheets or over the counter. But on these, what I was getting at, on these agricultural commodities, they're tracking something. See, a stock at any given point in time, in a liquid stock, the value is just subjective to what the market participants think it's worth, and they don't really have any way of knowing, and even then there's a lot of difference. These commodity tracking ETNs are tracking the futures for wheat, corn, and those prices are firm and pretty rigid. They're fluid. I mean, they change every day. But what I'm getting at is you're not going to get into something like wheat or corn. Yes, the spreads are high, but it's not the same as trading an illiquid stock. You just have to be aware it's best not to put limit orders when market orders when you buy and sell. Use a limit order. I like to split the difference between the bid and the ask. Maybe if it's moving up, go a little bit closer to the ask price. And sometimes they're not going to fill you, and you have to cancel or resubmit your order at a higher price. That's that. I just wanted to say that overall they do a good job of tracking. So if you don't know how to trade futures, you're not familiar, don't have enough capital, not comfortable with it, and you want to gain exposure, you want to diversify your portfolio, or just purely look for other trading opportunities, and these are your guys. So all right, enough on that. So T2 was hit today, 550. We closed at 552 on wheat. I'll post an update. I'm behind on a lot of the trade ideas, but so that is, I don't have where we entered it on here. Was it 511? I'd have to check. I'll post those numbers, but a nice big move there today, up 3.37% to hit that second target. So we'll probably get a reaction here tomorrow. Maybe not. Actually, let me show you the wheat futures real quick. I'm talking fast to get through the video, but at the end of the day, I probably don't even need to do that. You can, on any of the videos posted on the site, just click on the little icon. You play the video on YouTube, or click on that little gear icon down at the bottom, and then you can increase the playback speed, to I typically like 1.25 or 1.5, depends on who's talking, how fast they're talking, and then you can cut through these a little bit quicker. But okay, so I showed you that wheat, the ETN WAT, was at resistance, where that second target. However, when you look at the futures, which is much more important, again, this is what the ETN is attempting to track. Does a decent job, not perfect. And remember, you're not going to see the same percentage gains or losses because these have different trading hours. You know, wheat as an ETN, WEAT, is going to trade between 9:30 and 4 p.m. So it's going to show you the gain from the previous closing session each day or during the day, whereas these guys have their own trading hours. But here it is. That was a big level there. To me, that 541, 534 resistance, and boom, we blasted right on through it. So there is some potential divergence. It's potential because these indicators are pointing straight up. That's upside momentum. They could continue and take out the divergence. But if should wheat turn down, it wouldn't surprise me, especially with that ETN at resistance, because sometimes you get a case of the tail wagging the dog, whereas if enough traders, retail traders, I don't know how many institutional traders, but there are probably some out there that might buy WEAT, the ETN, but if they see that resistance and they book profits, it actually can then put some selling pressure on wheat futures, you know, as that ETN has to square off their positions. So you know, we could see this tomorrow, pull back there, and if we do, and you're trading futures, that would be an objective buy point. And if we go much lower, which is certainly possible as well, here's an uptrend line. So these would be the next objective long entries for a position on wheat. But like a lot of these ag commodities, I'm focusing here on these 60-minute charts, but the daily charts, as I've covered in many videos recently, look quite constructive. So you know, I'm viewing these as both combination of trend trade. Sometimes I'll swing trade, micro manage a trade, you know, get in and out. But this one I've been sitting tight with on some accounts, these wheat futures. You know, and with the stock market holding up for now and the ag commodity sphere starting to, you know, firm up, the charts there starting to get some upside momentum, as I've been showing you here, and I'll continue to show you. Here's one I haven't mentioned in a while, but MOO, it's agribusiness ETF. So they're not holding commodities. They're holding companies that are just involved in agribusiness. For example, you have John Deere, you know, tractors and farm equipment, all that stuff. Quite a few companies. I'm just clicking through a few of them. Archer Daniels Midland, Tyson Foods, things like that. So, yeah, but they're not all direct. There's Tractor Supply Company, and you know they're like a kind of a Northern Tool type competitor. But things in that arena, and again, there's just momentum in there, and that's why I'm clicking on a few of these. But let's get back to some of the individual commodities. JJG continues to look good. I mentioned that the other day. You know, pulled back to this 40.13ish level after hitting that 41.60 target. We had a breakout recently right here. Breakout above the downtrend line, the bullish falling wedge pattern, thrust up to hit my 41.60 target, pull back to that first target there at 40.13, and so far it's held that level. So another one that looks good right now. USO, maybe, yeah, I'll get to CL in a second, and I should hit on some of these individual ETNs if you are trading that. Story on crude, it's just hit a brick wall recently, you know, and you can see it on CL. I showed you CL today. On USO, it's about 29 and change, 29, we'll call it $29, $30. And again, I gave you the chart of CL this morning. Maybe I'll get to that one again. I just wanted to say, you know, looks like an objective short here, but crude's not going to fall. Most likely won't fall until the stock market falls. So, you know, shorting crude right now, as long as the market holds up, it makes that trade a lot tougher, harder. But there is a nice resistance just overhead, so you can, you could short it with a stop not too far above, but again, you may be caught in a dead money trade for a while. So I'll continue to follow up if I see anything interesting there. I covered natural gas this morning. Let's look at the futures. This is the ETN. Remember, they took away, I think DGAS and UGAS have since been retired. We've for years traded those. They had the 3-time leverage. They tracked pretty well, but like so many other 3-time leverage ETFs, they've gone to the wayside lately. So this might be one of your better plays here. It's been around forever. UNG, broke above the downtrend line here on the daily chart. Let me show you a few. There it is, NG. I pointed NG out this morning. Give you a static chart, a screenshot on the home page. It needs to take out both this trend line and that's 1786 resistance level right there. Nice little divergent low right here. If it can do that, boom. We already hit 1910, that 1910 target. I had that back here after this breakout and back test. That target was hit. When we hit it, we had a divergent high, so that was a catalyst for this correction. But the fact that we hit it once makes me think we may get another reaction or not. We've already checked it once, so if we can get a nice breakout going, this is the next target I'd be looking for, about that 2058 level right there on NG, or natural gas futures, and you just have to correlate that to UNG. I'll hit on PALL only because I haven't updated in ages, and that kind of goes with the comments I made earlier today. If there's nothing really to update, PALL's inofficial trade's been official short trade for a long time. We shorted it back here on a break below that 207 level. We hit our first target. It's in here. You can't see it either way. It was right here. T1, whatever that was, 179.86, hit T2, and we've bounced. We've been actually locked in a sideways range since then. So that's it. We need to either pop the upside of the range with conviction. If it does, and that would most likely coincide with more strength in the stock market, because this is a somewhat of a play on the economy. Palladium is used in emissions controls, so your emission devices for vehicles. So if vehicle sales go up, it's because the economy is strong, and therefore it should increase demand for palladium. And if not, we know the economy is not, at least the economic indicators have rolled over, then you're probably going to see this and a move down here to T3. But of course, we need to take out that range. We're in the middle of this multi-month trading range now, so really not much more to say on that. DBA, and one size fits all agricultural ETF, cattle, soybeans, sugar, corn, cocoa, wheat. You can see all up here. Still in this what appears to be a basing pattern. It's certainly a trading range, and it could be a bottoming pattern or a basing pattern. Again, we're seeing momentum in one after another. Not all, but quite a few of these those ETNs that I mentioned there, or commodities, are firming up. So I'm bullish on this one, but you'd really probably want to wait till solid break above that 1390 level before taking it to a full position on there. You're not going to collect dividends. I don't believe it shouldn't pay a dividend. These are holding commodities, not companies producing earnings. So if they have any spin-offs, it's just due to the structure of the ETF itself. Oh, and of course, it's a technical case to be made too, not just that I think commodities are a decent place to put money. Divergent low, just like back here. We have positive divergence in place at that most recent low there. So we just need that breakout, that catalyst to get going, and that's it. And here's ETN Cow, which is comprised of live lean hogs and live cattle, those two futures contracts. And it looks like it's pushing. If it can pop 31.32, I mentioned that as a level before. We did take out the downtrend line, but it's been pushing up above that, right around that 31.32. So we need to see a definitive pop above there, and that should take us up to this target, possibly up here as well. Typically not so good for livestock when the grains are rallying, because that raises that input cost to the farmers. But sometimes you can see things moving together, things that have an inverse correlation at a majority of the time. So here's HE, lean hogs futures, a little uptrend line there, and you can see a comparable level, just like on the ETN that I showed you a second ago on cow. You need to pop this level right about here, about 51 and change, and that would be bullish. And so if you're going to trade cow, then you want to watch these futures. A lot of brokers will give you these quotes. You can get them from investing.com. Again, this is they might have a different symbol on investing.com, but this is a symbol if you trade it, HE. And then you have LE, which are live cattle. And those, it looks to me ready to pop. This is a level I've been highlighting, 101, 448 or so. We'll call it 101.50 or 45 if you want. It seems like we broke out of the downtrend line there. We did break out of the downtrend line, zigzagged up, and we've been pushing along this level for a while. So breakout above there would take us up to about that 112 level. and possibly more, of course, if that's taken out. But as I like to say, resistance is resistance until and unless taken out. One thing you have to watch for, although PPO was turned up here at the zero line last time I highlighted, put this arrow down here, where PPO was curling up or coming down to test it, and it has. So we'll watch. If we get a breakout, one thing to be on the lookout for, if we get a sharp reversal, it could look something like this. See the potential divergence forming, and there's one possibility there. So if you do see a reversal, you want to hold a little bit below that 101.448 line. Yeah, I'm leaning towards an upside breakout here and a run up to that level. So we'll see. We'll keep an eye on it. And again, that's just one of several different ag commodities out there that you can trade. And somewhat hedges up too when you're long cattle or hogs and or both, and then the grains, somewhat of a hedge, but like I said, the charts are fairly constructive on both right now, so that's why I'm covering these. Soybeans, nothing major to report. We broke out of this downtrend line recently and been zigzagging our way higher. There's an uptrend line to watch. Ideally, it will stay above there. That may also provide another objective long entry if it pulls back to that level. But that's it. As of now, like most of these, in an uptrend recently. Still in a larger, longer-term downtrend. Make no mistake about it. Could be a bear market rally, or there's increasing evidence on the daily and weekly charts. We could be looking at a major, or at least a tradable bottom in a lot of these commodities. Corn, keep in mind this is an old chart, old targets, old trade that was already stopped out back here, but I've continued to update it because I still liked it. And that one, so I've just been lazy. I haven't cleared these lines out. I think that's because I haven't posted an official update on the trade and moved it out of that category. And once I do, then I can take away some of these. But since this breakout here, the downtrend line, we have been moving higher. It pulled back today, so corn was underperforming, not big. It was down, at least the ETN down a quarter point, and ideally you want to keep it above this previous reaction low. If we can turn up here soon, you have all the makings of a new uptrend, which is a series of lower or higher lows and higher highs. And then if we can take out that downtrend line right there, that would be quite bullish. So that's CORN. Joe is our coffee ETN. This one is an official trade that's active right now. Already hit the first target resistance. I'm sorry, first resistance level pulled back. I want to show you the futures. That chart looks interesting right now. All right, this is KC. This is my preferred trading proxy here. And you can see on KC coffee futures, we had a nice divergent low here on the 60-minute chart. There's your bullish divergence. We had a trend line break. Actually, I had dual trend lines. Both of them were taken out. There's your breakout right there. Zigzagged higher. Nothing goes up forever. We had a little divergent high put in right there, at least on the RSI, and that was the catalyst for this pullback here. Now, this pullback at this point, let me blink out all those lines, is taking the shape of a falling wedge pattern. So we're still above the downtrend line right there, and now I can draw this little wedge type pattern right here, and there's your small divergent low. So we may zigzag our way down within there, possibly, but if we break out, and that's what I'm leaning towards, a breakout, that would be your next objective long entry. And targets, well, we've already hit all the way up here to my 104 target after the breakout. So I'd be looking for a move up and beyond there to the next target zone right here, about 106 to 108 at a minimum again. And NIB, the cocoa ETN, still looks good. Here's your divergence line right here, positive divergence, and a pullback to trend line support. Here's a trend line that goes all the way back to early 2017. Lots of reactions. Keep it simple, watch, rinse, repeat. You buy pullbacks to that level. It's an objective long with a stop somewhat below. I'm not putting that exactly where it needs to be, but solid break below. Remember, this market's plagued with whipsaw signals. It's just the nature of the game. So I wouldn't put a stop. 0.5% below the trend line. I'd give it a little bit of room, and ideally on a daily closing basis. So it still looks good, still an objective long entry here, and it hasn't run away yet. We had that tag the other day. We bounced off the initial tag, and we've pulled back, so we're really close to the trend line. And of course, markets are closed now, but that's one to look for tomorrow maybe. Especially if you get another pullback all the way to the trend line. And if we do break, let me just say this in advance, if it does break the trend line, I wouldn't go long at that point, but if it snaps back above, I would, because that would be a I'm talking going forward. That would be a whipsaw signal, aka false breakout or false breakdown, and that'd be bullish again if it recovers. As of now, we haven't broken the trend, so let's just keep an eye on it there. Cotton continues to do its thing, working its way up within a price channel. Like a lot of commodities, bottomed in last few months, and it's been in an uptrend. So there's been more money to be made here in the last few months in most of these commodities, especially in recent weeks in the stock market. I'm talking about the S&P 500, the broad market, the Dow, which has been locked in a trading range now for just over a month. And copper. I mentioned copper the other day as looking for a potential short here on copper futures. Copper, the ETN we're looking at here, had resistance and still does at 1804. This is what I call a momentum fueled overshoot, or what I believe will prove to be. You had a near parabolic run there, almost a vertical spike. Everybody's been tripping all over themselves to buy copper lately. It's a momentum trade, like a lot of things in this market, and so far that breakout above, you can see the reversal, and we're not back below the $18 level yet, and here's a trend line. So the safe bet's probably to wait for that trend line to break, and if so, copper may present a nice pullback trade. So I'm keeping an eye on it. Like I said, I'm not adding this as an official trade. I don't even have it a position yet, but I'm considering it. And last but not least, let's talk about the precious metals. Gold still has that potential divergence high. I call it unconfirmed because the PPO is not turned down and put in a lower low with a bearish crossover, but it's getting there. We're very close. This is an official trade, has been for a long time. We're very close to that fourth target. So as I said the other day, I think it's prudent to tighten up stops. Don't let it get away from you. If it breaks this trend line and starts to go much lower, much below that, you might want to pull the plug, because these divergences, same divergences you've seen in the past that have played out for corrections. The primary trend in gold is bullish. It's in a bull market. There's no doubt about that. But you can see over time you get these divergent highs, and even in a bull trend, they're good for pullbacks and corrections. So sometimes as a trader, even a trend trader, it's nice to sidestep the bigger pullbacks, the ones that are high single to even double digit pullbacks in gold. So that's it. Those divergences, like I said, are still very much intact. Here's GC on the daily time frame. I know you can't see the prices and all these the annotation boxes. It's a limitation of this charting platform. I put those on a 3-month and hourly time frame, so you can see, just showing you these recent series of consecutive divergent highs. Divergent high 1, little uptrend line as well, to trigger the sell signal, correction. Divergent high 2, correction. Divergent high 3, correction. But we're still above that 1790, 1791-ish support level, which was the top of the recent trading range. But gold is really kind of stalling out here. And it's not, it's not the ideal price action after breaking above that top of that multi-month trading range, which is cut off here to the left of the chart. We could look at it. We came in and back tested. So here's the thing. I remain cautiously bullish. I'd like to see a little more upside. I think we get out of that official trade. If I have to modify or lower that target, I will. I'm leaving it alone for now on GLD, and then if we hit that, I'll kind of step aside and see where things go. But now, if it breaks 1790, if it breaks it with conviction, that's not going to be good. You can see that we have the divergence here also on the 60-minute chart, as well as the daily and even the weekly chart on gold. There's been a couple inquiries on that on the homepage recently, is why I wanted to bring it up. Silver ETF, same thing, negative divergence right here on the daily time frame. This was just a triangle pattern we broke out of, and that was bullish about the time gold broke out of the recent trading range. I'm talking this GLD. There's the trading range right here, this box. See, gold broke out, had this thrust up, and there's that uptrend line. And then silver on the ETF, you have a almost a similar comparable trend line to watch right there, and the same thing, divergence. And I take these divergences serious. We don't have any sell signals yet, and we did have some recent breakouts, but you don't want to ride out some of these big givebacks. That one was excessive right here. This was a liquidation forced drop right there. That was the COVID drop into the March lows. So everything was getting sold off due to liquidation. So, but even then, you can see these divergent highs right here. Let's see that one back there. Let me just measure it for you and give you an idea. That was a drop of about 12%. So you probably don't want to ride out a 12% drop if you have some nice gains on silver. And as far as shorting it goes, well, the same levels I just showed you to watch these trend lines there. Let's see if I can show you silver futures. Here's what silver futures look like on the daily time frame. Nice, fairly clean up trend line, wedging right there, divergence. So I think it's safe to say at this point the next trade in silver will be a short trade. Break at that level there. Target would be about down here on this daily chart, about 17,423. Again, those are daily candles. That's 18 months. Let's look at the hourly chart. Hourly chart, here's your smaller, uptrend line right there. Divergence here on the 60-minute chart. So break of this minor trend line would most likely bring us down to, let me give you, I was going to say right here, this trend line. That's certainly a potential target there, but I also want to give you a price, horizontal price support level I can see right about here. And what I'm focusing on is this reaction high. Then we broke above it and we back tested it a few times there. Oh, they actually come in together, so that's perfect, all the better. There's the target right there for a pullback trade in silver. That's 18,878, call it 1888, 1890 or so if you don't want to try to squeeze out every last penny. And if it happens soon, that'd be about a 4% drop, and I do think we would probably get a reaction if we dropped down there soon. Probably get a bounce on that level. So not a huge move, but if you're trading silver futures, I don't have to tell you, a 4% drop in SI is going to put a few grand in your pocket, per contract, that is. Okay, to wrap this video up, we hit on everything I wanted to cover except the currencies. Somebody asked about those, and they're worth updating. I haven't updated the dollar in a while, or the euro. I've been longer term bullish on or bearish on the dollar, which also plays into that's typically bullish for gold. But let's just look at the dollar by itself right now in longer term charts. It's fallen to a pretty decent support. The one reason I've been bearish is not just the fact we're printing money like there's no tomorrow, and sooner or later the world's going to realize that we got to pay for that, but it's also technicals, because you had right back here in UUP, the dollar ETN, you had a divergent high, you had that big correction. That ended with a divergent low, which was a catalyst for this rally, and you had a divergent low here, catalyst for that rally. Things got wonky around that meltdown during the coronavirus. There was a brief shortage, a crunch for demand for dollars that caused this spike up here, but what it did technically, it just extended the divergence. And we've been coming off, that's a big drop in the dollar from that point, and we're at this 26-ish support right now. About $26 right there. You can see on UUP. The other one I like to use is look at the euro. You can look at the euro-US dollar pair, and it's almost an inverse mirror of the dollar chart. So when this is bullish or rising, the dollar's going down, and it's all in the technicals. We can all sit here all day long and say why the dollar is going to go up or why the dollar is going to go down. That's what they do on CNBC all day long, is share their fundamental ramblings and make a case. But to me, the technical case is pretty solid. It was a big divergent low, and now the thing is, just like the dollar's at support, it's not mere coincidence that the euro is at resistance. So that's it. So you have both there. Where do we go from here? I'm not so sure, but I can say a solid pop above there would be bullish for the euro, and that would be bearish for the dollar. Likewise, the dollar would break that support I just covered. And let's look at DX and E7. E7 is the contract for the euro futures. Right there's a nice price channel. And also you have some divergence recently, small divergence right there forming at the top of the channel. So there it is. You need to break that channel. If I go back farther, we'll probably see the resistance that I just showed you on the daily chart there. But that's it. Look for these divergent lows. Divergent low, they're bullish. You get the rallies that come afterwards. In fact, this is all part of that rally off this divergent low right here. And then you look for the divergent highs, and that's typically followed by corrections like this one there. Dollar futures, and we'll wrap it up. The last update on the home page on the dollar, I'd highlighted these two divergent highs here. Well, I actually started out highlighting this divergent low, waiting for a buy signal, which we got there. It's a catalyst for this rally. Hit my 97,585 target several times. Hit it here with the divergent high, and I had a breakdown reversal. Hit it here again. So the last update was a few days back. And I highlighted that we're in this trading range, and that the next break above or below would likely determine where we go from there. And we broke to the downside. However, we are at, as I showed you earlier, support there on the dollar. That's that previous reaction low. We also have bullish divergence. So to take my best guess, I think the dollar will probably rally from here over the next couple days, most likely. If it can break above this downtrend line right here, then we might get a pretty decent rally. At the very least, I think we pop back up here to test that downtrend line. If so, that's likely to put pressure on gold. So near term, we're talking tomorrow, next couple of days, I'm favoring that the dollar bounces and the euro pulls back. And I think that's enough for today. All right, long video, but a lot covered, and hopefully you guys found that useful. This has been Randy Finney with Right Side of the Chart. Have a great evening.